Well, farmers certainly engage in numerous types of sales transactions, typically involving crops and livestock. However, they can also receive income from other types of sales and services. Now, each of these transactions has its own income tax reporting requirements. So here to answer a few questions is Roger McEowen. He's with Washburn University School of Law, joining us with the latest in today's Rural Money segment. And Roger, as always, thanks for joining us here today. So what are some of the additional services that could generate some of this income?
With you this morning, and there actually are quite a few things that farmers might derive income from. We think often of breeding fees, for example, and other sale items such as soil and mineral sales and income from crop share rents or selling livestock, or what we call 1231 assets or land sales and crops and feed. So the situations are many and varied for farmers.
So what do farmers need to keep in mind, of course, when it comes to soil and mineral sales?
Well, if they sell soil and sod on a regular basis, that's going to support characterization, at least with respect to the IRS, that those sales are assets that are held primarily for sale to customers in the ordinary course of business, and that means it's going to be ordinary income. Now, if it's a mineral deposit, then disposition of the minerals could be held to be a sale that's reported as a capital gain. But that's probably not going to be the case in most situations. It's more likely that a lease is involved, and if it's a lease, that produces ordinary income. So you have to be real careful as to whether you have retained an economic interest or not to determine whether it's ordinary income or capital gain.
And then what about those crop share rents?
Well, that one gets a little tricky because you might get the crop share rental income in 1 year and then feed it out to livestock in the next year. And that is income in the year that crop or livestock is reduced to money, or its equivalent, or it's fed to livestock, or you donate it to charity. So you got to watch a timing issue often with that.
Now, Roger, is there any type of special form of tax treatment for gains and also losses arising from the sale of certain capital assets?
Yeah, the big one there are what we call 1231 assets, and that can include horses and cattle and other types of livestock. And there's a different holding period that's required, whether it's 12 months or 24 months. And that gets into a tricky area of the law as to what is known as a 1231 asset. So you really need to be having your tax practitioner look closely at those types of assets.
Roger, I want to sneak in an extra question here. What about some of the services that we might do, whether you're hired by your neighbor or somebody across town on another farm to maybe do some extra work?
Yeah, and that's basically independent contractor income. And you might get a 1099 non-employee compensation for that. Just make sure that that gets reported and is characterized properly. That's generally going to be wage income if that's hired hand income.
Well, any big takeaway that we need to keep in mind here, Roger?
Well, I think the big point here is that farmers can derive income from a lot of different sources, and it's important to report that properly to avoid IRS scrutiny. Now, IRS, of course, they don't do too many audits right now, but if they get additional funding, as Congress is talking about right now, then they're going to be armed for bear, so to speak. So we have to be careful in properly reporting these things.
All right, Roger, as always, thank you very much for your insight here today. Roger McEowen, he's with the Washburn University School of Law, on the phone with us today out of Kansas.